Welcome to Academic Gain Tutorials. In this video, we will look into the differences between open-ended and closed-ended mutual funds. Mutual funds can be described as a collective investment avenue. Investing in a mutual fund is like becoming a part owner in the portfolio of investment. Based on the structure, a mutual fund is classified as open-ended and closed-ended. Open-ended funds, as the name suggests, are the type of mutual funds wherein the investor can enter and exit anytime. On the other hand, closed-ended funds are the ones which the investor can buy during the IPO or from the stock exchange after they are quoted. So, let's look into the basic differences between open-ended and closed-ended mutual funds in a tabular form. Difference number 1. Open-ended funds refer to the mutual fund, in which the investor is allowed to buy shares anytime, even after the closure of the NFO, that is new fund offer. As opposed, the shares of closed-ended funds can be bought only during the new fund offer, that is, after the NFO is over, the investor is not allowed to invest. Number 2. The subscription of the open-ended mutual fund remains open on a regular basis, that is, it accepts funds from the public by providing its units. Conversely, the subscription of closed-ended schemes is open for a short period only, that is, from 1 to 3 months only. Number 3. In the open-ended mutual fund, there is no fixed maturity period, whereas there is a definite maturity period in the case of closed-ended funds. Number 4. The liquidity is provided by the fund itself in the open-ended scheme. As against this, in the closed-ended scheme, the stock market provides liquidity. Number 5. In an open-ended fund, the corpus is variable because of continuous buying and redemption. On the other hand, the corpus is fixed because no new units are offered for sale beyond the limit specified. Number 6. The shares of the open-ended mutual fund are not listed on an exchange, rather the transactions are performed directly through the fund. In contrast, the shares of the closed-ended mutual fund are listed on the secondary market. Number 7. In open-ended scheme, the transactions are executed on daily basis, while in the closed-ended scheme the transactions are executed on real-time basis. Number 8. In the open-ended fund, prices are determined by dividing NAV from shares outstanding, unlike in the closed-ended fund, price per share is ascertained by supply and demand. And, difference number 9. The selling price of the underlying security in the open-ended fund is net asset value, plus load if any. On the contrary, in the closed-ended fund, the selling price of the underlying asset premium or discount to net asset value. One of the major disadvantages of the closed-ended funds is that it does not allow the investors to withdraw the amount invested in the fund when they desire. In contrast, the open-ended funds offer flexibility to the investors in this regard, as they can withdraw money on a continuous basis under the repurchase agreement. So, these are the differences between open-ended and closed-ended mutual funds. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.